how the market maker creates trends on micro and macro scales. Thank you guys for tuning in today. Today's video is super special. Now, it's a super simple concept. We only added 5 different EMAs to our chart. We have the Fibonacci ratios on there. I think we have 13 of them just in case the 12th one fails. We have the ABC just because it's orange. I love how it looks. The ABC, makes us look smart. And we can't forget the Elliott wave, the big red triangles right in the middle, obscuring about half of our chart. But that's okay, because this is going to tell us the exact direction of the trend. Now, you guys, all right, who am I bullshitting? First off, what we're going to do is remove every freaking indicator that we have, all the drawing tools, all these BS tools that we're told, that we can use to make money, when really in the end it's all been to brainwash us. So let's get back to business here. Understanding basic market structure. Now, this video is on understanding how the market maker creates trends, right? Specifically, micro and macro trends. Now, to understand how he does this, you need to have a basic understanding of market structure, right? So what we're going to do is go and enable the session breaks on our chart, and this is literally all we need. Session breaks and a naked chart, completely naked. And I'm going to use GBP/USD right here as an example, but this goes for every single FX pair that isn't absolutely crazy, like the, USD MXN, the USD Mexican Peso. That one's kind of crazy, but every single pair that's relatively normal, or that has, the USD at the end of it as the base pair, all these pairs, this is the basis of how trends are created. And trends, everybody knows trends. They tell you to go with the trend, and apparently that's really all you need to know when trading, except nobody understands how they're created. Now, this video is going to give you insights on how they are created, and hopefully you can make a shit ton of money by understanding this. So, understanding the week, basically the weeks. Now let's chart out the weeks on here on GBP/USD, for example. Now, like I said, this works on basically any pair that has a relatively normal amount of volatility, intraday volatility, for example, like this on GBP/USD, maybe 100 pips or 150 pips, 200 pips. That's relatively normal volatility. Anything over that, 300 to 500 pips, that's pretty crazy, and you shouldn't be trading that because, well, unless you know what you're doing, obviously. So, let's go over the week. Now, we have to chart out the weeks on here to basically understand how the market maker structures the overall weeks and months, because the market maker has his limits as well. We know that the market maker can't go up 300 or 500 pips a day on GBP/USD. Its normal range is like 70 to 150 pips a day. So We already know that, and that's, that's normal for most pairs. Now, let's go on with finding the start of the first week here. This is the start of the week. How do I know that? Because there's a little gap here. Right there, you can see the little gap. So that means it's Sunday. The market opened there. So that's week 1. This is week 1. And this is the end of week 1. Start of week 2. Here's the end of week 2. The beginning of week 3. Here's the end of week 3 and the beginning of week 4. And here's the end of week 4. Here's week 5. And here's actually the new year. This was actually 2017 going into 2018 right here. New year, new month right here. This is a new month. New month, new year. Alright, so we have a period of 5 months. Now, as a retail trader, they say to go with the trend, right? So let's actually plot out the trend. Different trends that we can clearly see here. I'm just going to do the best I can to plot these out as a normal retail trader would do. Alright, and there's also trends within trends that we'll get to later, but for now, let's just draw these obvious trends here. As if we were, very smart retail traders, just, trying to trade this downtrend. Now we have to take into consideration that we're on the 15-minute chart. Now, there are people on the 1-minute chart, there's people on the 5-minute chart, there's people on every single chart, right? I'm going to show you guys the 15-minute chart because it's relevant. It's relevant to the basically how the trends are created on an intraday through the week and also on an intraday scale. So, and also not only on a weekly scale but also on a monthly scale. So we'll get to that as well. Now let me change this to a different color so that we can see it is a completely different trend. This is where the micro and the macro meet. So there are people trading the red trend, right, the downtrend here, but there's also people trading the downtrend within the downtrend, right, the blue downtrend here. Now, let's understand what this structure is. Okay, we have December right here. This was the start of December, the high of December. This is a new month. A new month, the new month's high. This is the high of the old month. And this is the high. This is the complete high of it. So this was November, right? This is December. So this was the high of December. This was December's high. Notice how the new month right here, they worked off of December's high and did not hit December's high until the last day in December, and there was a new year. See that? See how they do that? Now, this is only one piece of the puzzle. We have to understand the why this happened. Why does this happen? So, first of all, let's go into the ICTG.org. Now, I have no idea really how I found this. It was just completely coincidental. But this website, basically complete coincidence that I found it, but it shows basically phases of disaster and how your emotions react to it through time and on a micro and macro scale, 1 to 3 days or 1 to 3 years. Now, there's different variations of these, right? Just like in the market, there are different variations of market structure. So, it's the same thing though. It is the same concept, right? We have the consolidation, right, which is the pre-disaster, the warning, the threat right here. The impact, or well, basically that's a bad example. This is a good one. I guess it's the same thing. All right. We have the pre-disaster, the consolidation, the fake out, and then the real move, right, to the downside. This is the exact same thing, but just the opposite. We have the consolidation here, the fake out to the downside, and then we go up. But why is that? This is the first month that we're analyzing here. Excuse me, the first week, not the first month. First of all, the first week, right, Sunday going into Monday, Tuesday, we have 2 days of consolidation. Not only that, but this 2 days of consolidation is added to this consolidation right here. Now, what's going on here? Right here, this consolidation is only happening because, well, it's happening to get retail traders to place trend lines here, okay? That's the only reason, that's one of the reasons why consolidation happens where it happens. So, retail traders have placed their trend lines here, and retail traders that trade breakouts will sell this breakout right here, and they'll also sell this, and this is a trap, right? Why is it a trap? You can see the market completely reverses. So the first 2 days, look at how we also had our trend lines, just like retail traders are taught. We also had our trend lines going down. You know, it's a downtrend in every retail trader's mind. So You see that break, as a retail trader, you grab that as a sell. You're trapped there. Within 2 hours, they trapped you and went 285 pips in the opposite direction, hitting any stop loss you had or blowing your account as a retail trader. Now, let's chart out the days of the week. Sunday, Monday. If you guys go and watch our previous videos, you can see a lot about market structure as well. Tuesday, Wednesday, then we have Thursday and Friday. So, how did the market react midweek? Basically, we had our first 3 days, right, which were basically consolidation and a trap. And then we had a reverse in the market of about 300 pips to the upside. They created a high. A new month came in. December came in, right? Here's November's high. December, the market maker has their limits, right? The market maker has their limits. So, with that being said, take a look at this. This is November. So this is the low of November, and this is the high of November. The market maker had a limit on the month of November of 500 pips. He could not exceed 500 pips. So, understanding basic market structure, the market makers have limits and goals, right? They have their limits, so they can't exceed a certain amount of pips per day, and they can't exceed a certain amount of pips per week and per month, right? I'm not going to go into depth on how many pips per month it is, or per week per pair, because it averages differently per pair and it's obviously only an average, so each month it could be different, right? Now, Sunday and Friday are trap days. Why are they trap days? Sunday is a trap day because we have every single retail broker that doesn't have a fixed spread manipulating their spreads on Sunday, because Sunday there are usually gaps in the market, and it's usually very easy for market participants to make money on gaps, because usually gaps fill because there is liquidity in the gap itself when it is created. So retail traders know this, and there's a lot of YouTube videos about it, and about it being, the easiest trade to win. But a lot of times, the dealer will make a gap and then wait, hit all the stop losses, and then come up and fill the gap. Now, each time they make a gap, it's different. They make them for different reasons, and I have different videos about that as well. But basically, Sunday there is a chance of a gap happening, and the manipulation of the spread, which could be, let's say GBP/USD has a normal spread of maybe 5 to 8 pips on a variable spread broker, right? 5 being kind of normal, right? 8 being kind of high, right? And a manipulated spread on Sunday would be somewhere around 18 to 20 pips right on Sunday open. And then it'll taper off into Sunday come Sunday night into Monday, right? They do this because of the gap and other reasons. Because a lot of people, a lot of retail traders are anxious to trade. You know, it's like a holiday for them. They get the trade, whoop-de-doo, woohoo, the market opens, right? Everybody's super, they FOMOing, right? Fear of missing out, right? So, Sunday, Monday, Tuesday, Wednesday, then Friday, the trap day comes. Notice, Thursday, they made the high of the month. Friday, they trapped at this high. They trapped and then reversed. They didn't just trap and stop, but they reversed the market. So they were going in an uptrend. Now they reversed to hit the stops of anybody that was buying up with the uptrend, right? So they trapped people, retail traders, going long at the high of the previous month. Now, Friday, the market traps people here, and what happens? A completely new trend is formed. A completely new trend is born. Now, this trend has a market structure that I really want you guys to pay attention to, because it is the basis of how trends are created, okay? So, come Friday, what comes after Friday? We have Sunday, Monday, Tuesday, Wednesday, Thursday, and Friday. Now, pay very close attention to this structure. How is it any different from the previous week? Right? This is week 1. This is week 2. How is this week any different from this previous week? Well, it's only inverse. That's the only difference. The only difference. It's just inverse, right? So, the week starts off basically in consolidation here. A very large spread consolidation of about like 80 pips. And then we can see a break to the high. Now that was not only a break to the high of the day and the week, so this is the high of the new week and also the high of the day at the time, but they also broke to the high of the previous week and the previous month, right? They tried to grab orders at that month, at that previous high there. So, what happens then is the dealer will open the spread up here at that high and activate any orders, any buy limits that are set above the high of the previous month. Right up here, right? So, that spread only needed to be opened 10 pips to activate any orders at that previous high. Then the market reverses. Now, what do we have here? This is that whipsaw formation that we talk about all the time. And that's how the market, the trend is created on this, in this example. All right. Now there's something even more, a little bit crazier going on here. So within this smaller trend, this blue trend here, there is also a red, right? The red, the macro. Now this is what I want you guys to understand a little bit more. We said that Friday is a trap day, right? Thursday, we also talked about, right here, we have midweek reversals on micro and macro. Why? Why do they happen? So we talked about why they happen a little bit. We have the market, the trend going down for half of the week, almost half the week, and then they reverse halfway into the week. Now, here they did it, the market makers, all right, the dealers, whoever you want to call them, they did that. They reversed the market a little bit early in the week. But here, in this example, Wednesday, it's midweek, the low was created, and Thursday, they reversed the market. This was to hit any stops of the retail traders that were trading this trend here, the trend within the trend, right? And now a larger trend is created, a larger trend is realized, right? Now the retail traders are going to be plotting the trend lines here and trading the bounces off of these, the red, right? It's all about reacting to what happens. Not trying to predict it, but reacting to it. And if you can react to it before it happens, or as it's happening, then you can basically, profit off of the move that it's making, that the dealer is making. So, why did this reversal happen? To hit the stops of any people selling in this trend here, right? The trend, the artificial trend that was created in this, the macro. So the micro was basically a trap, and then this was to hit the stops. Now, Thursday, like we said, there was a midweek reversal, and then Friday, we have a trap day. They reversed the market again. If you thought they were going up, well, nope. We decided to go down today. Why is that? They worked the high of the week. Here's the high of the week. Sunday they made that high. Whoops. Sunday they made the high here. Friday they came and just about hit that high. Not quite, but just about. And then reversed. So, we have a new week now. I also wanted to talk about how these structures basically form the trend, right? So here we have the same concept, all right? This exact same concept here, right? Where we have 3 days of drop, 3 or 4 days of drop, where the market maker induces retail traders to sell. And then here's that one last attempt to make them sell, right? Same thing happens. 2 days, 1, 2, 2.5. Here we have 1, 2.5, 3, about 4.5 days, maybe 5 days, no, like 4 days of selling going on. And then 1 day, 1.5 days to take away the money, right? Boom. Of anybody selling that got into this trend here, because it became too obvious, right? If the retail traders continue this trend, they're going to lose money because, if the market maker continues this trend, this pathway, this blue trend, they're going to lose money because it's becoming too obvious, and the retail traders will jump on it, right? So they have to induce the retail traders short and then go long, just like they did here. Induce short, go long. Now, hit the high of the previous week, just like they hit the high of the trap on Friday of the previous Friday. They trapped on the previous month. Here they're trapping the previous weeks, the previous Friday, and also the previous high of the week. So then reverse the market and start all over again. So check this out. Let's actually trace this. Let's actually trace what we see here. And let's do it in a really nice looking marker. Purple. Whoops. Okay. Here we have the start of the week, right? Why is that? Because there's a gap, right? Sunday. Let's go up and just trace it. And now we'll understand why I'm tracing it in a little bit. Alright. Oh man. Okay. That turned out really bad. Let me do it really quick here. Boom, boom, up, down. Create the low. Create the high of the week. Friday, they drop. And now. So, this, right here, what does this look like? Well, that looks to me a lot like one of these structures, right? To induce a response. To induce a response. Now, check this out. This is the previous week, right? This is week 1, or no, this is week 3. Okay, we're looking at week 3 right now. Let's compare week 3 to week 2. Identical. Almost the same exact structure, right? Now this is how the trends are created. I went and created a video on how to trade larger structures, and showed the whipsaw here that is used. This is the same exact concept, but on a different scale, right? So, the same exact concept. And this is for every single pair, you guys, not just this example and not just GBP USD, right? This is every single pair. Just understanding relative market structure, understanding the market structure. So midweek reversals, why they happen, right? And then high and low, understanding the high and the low of the day, the week, and the month. Market makers have their limits and the 3-level market maker myths. Now, a lot of people that I guess trade what they call the market maker method use have an assumption that the market has 3 levels to it, and there's only 3 levels. Now, I also thought that, but it's very, very subjective. The market is very subjective, and you can't always have I guess there are times where you could see 3 levels, or I could see maybe 4 levels. Or, there were just too many times where it was so subjective that you can't trade it because it's too subjective, just like indicators. And the market maker method also has so many indicators with it and templates that it just becomes its own unique, I guess, indicator. And that's why I stopped believing in, these different myths about the market. For example, the 3 levels and whatnot. And now I'm going to show you guys why exactly there are 3 levels in the market. Sometimes 3 levels. Now, I went over in different videos that there are, when the dealer creates a trend and it becomes obvious, is on the 3rd hit, right? So, to give you guys a better example of this, we have 1, 2, 3 hits to the trend line that we have here, right? And these 3 hits now have the retail traders drawing this trend line out, right? We don't just have 3 hits, we have 4, 5, and then maybe 6. We have a lot, right? This trend was becoming so obvious to retail traders that they just had to jump on. They were FOMOing like crazy. They had a fear of missing out. Why? Why is that? And where for the most part is that? Now it's really obvious. Right in here, right in here, and right in here. So right in here is a massive sum of retail traders doing what? Selling with their take profits and stop losses where? Their stop losses are here. Their take profits are somewhere down here and here, right? Why is that? Okay, their stop losses are not only right here, but they're going to be above this high, and above the high of the month, right? Not only do they have stop losses above, the highs of these previous highs, but they also have their stop losses above the high of the month. Some traders, right? Not all of them, but just some. Now, we're not just talking about the select, the massive sum that's sold in here, the chums that's sold in here. I'm talking about also all the people, all the retail traders that were selling in here, right? Because this was, okay, get a load of this. We have, remember we have 1, 2, 3, 4.5 days of drop. in this week. There are, 5 days? There's 5 days in the Forex market. So there's 4 days of drop here. There should be 4 days of drop and 1 day to hit the stop losses. 3.5 days of drop and 1.5 days to hit the stop losses. Okay, why am I even talking about this? Well, this same rule of the market maker inducing retail traders Sunday, Monday, Tuesday, and Wednesday, midweek reversal, they reverse the market to hit the stops, and they create the trend here, right? This trend is being created by retail traders. It becomes obvious, and in the middle of the week, the dealer has to reverse the market because it becomes too obvious, right? This same thing happens on a larger scale, right? This same exact concept happens, but on a larger scale. So this is the larger scale, right? We have 1 month. So let me delete all this junk. I'm sorry. These charts get so messed up. We're just going ham today, you guys. We're messing up these charts like crazy. Okay. So we have the month. We have the macro, right? We talked about the micro and we lost our chart. Okay, we talked about the micro, how we have that induce and then hit the stops, right? That also happens. Let me get a different marker. That also happens on a larger scale. So, induce, hit the stops. Induce, hit the stops, right? That's how the trend is created, right? And then, that's the micro. What's the macro doing? Well, here's December. Here is the new year. So, for a good 75% of the month was in a downtrend. Us retail traders spent 8 days in consolidation in about a 85 pip consolidation range right here. So they give us retail traders 8 days to sell. Why are the dealers, the market makers, not going to violate this low right here? Why? Because as we talked about before, where are the take profits of the retail traders? They're right down here. The market maker is not going to make any money if he hits those. He's going to lose money. He only makes money when he hits your stops. And that's not even him sometimes. That's usually the broker that's making the money, because they're hedging against you. So, most of the week, they spent creating an artificial trend to get you to sell this trend. And then, guess what? In 2 days, it took 2 days for the dealer to go up 150 pips and hit just about every stop. In 2 days. It took 26 days to create that trend and 2 days to take the money from anybody that sold in that area. Now, this whole conversation started because of the 3-level concept. Now we're getting off track a little bit. So the 3 levels, what does that have to do with anything, right? We talked about how there are 3 levels. The rule of 3, where the dealer creates 3 hits to the trend line, right? And then that apparently validates the trend. Not only validates it, but it gives the retail traders a structure to work with. So they create the trend, okay? Then once the 3 hits are done, the dealer has done his job, okay? His job is completely done. He doesn't need to create that trend anymore, because if he continues with that trend, if he goes down, he is going to lose money. It becomes too obvious, right? He must go up in this case, in this example. So, what does he do? In 3 levels, 1, 2, 3. Why does it happen in 3 levels? That is the question. Why are there 3 levels? And you know what? This could be a level here. You know, this could be a level here. It's all subjective, right? But in this case, I see 3 levels, so it's 3 levels. That's what we're going to do. Okay? 1, 2, 3. Why is that, though? Why? Because the 3 hits that they created here to do to create the structure of the trend, what's above these highs here? What's above these points right here? These previous highs. There's going to be stop losses above these highs. So they have to rush in 3 levels to take out the stop losses. Level 1, what happens in level 1? They hit the stops of anybody selling that had their stop loss above this previous high. What happens level 2? Same thing, just at a different high, at the previous high, right? Level 3 finishes anybody off at the high of the previous month and the high of this month, just in time for the new year, right? This is 2018. The new year happens. Notice how this was the high of December. They did not break that high until the new year. The market maker had his orders given to him to do not to break that high, the high of the previous month and the high of December, until next year, and then follow out orders of next year's plans, right? What were next year's plans? We can see, boom. Okay, and take this for example. Okay, the market maker had maybe he was given an order to keep the spread within 250 pips or so, right? So that's what he did. He could not move the market any longer until next year, or in this case, next month. So next month they were given new orders. They gave new orders to the algorithm that creates the market, because it's not a person. And we're going to go into in depth how the market makers really work. on our next video. So stay tuned. If you guys enjoyed this video, give it a thumbs up, subscribe, smash that like button. Thank you guys for tuning in. Peace out.